If you look carefully at what happened to silver throughout 2025, you'll see something that should make any experienced investor pause and reflect deeply. Silver ended 2025 with a 148% gain, one of the best years in the modern era. It went from approximately $29 to over $72 per ounce, hitting peaks above $86 before pulling back with profit taking at year end. This isn't just a market rally, it's a signal that fundamental forces are moving beneath the surface of our economy. When silver rises too fast, it exposes what nobody wants to see: hidden leverage. When margin tightens, the market doesn't debate thesis, it demands liquidity. Liquidity is getting more expensive. If you understand historical patterns, if you truly understand how markets function when money becomes questionable, then you know this isn't just a trading opportunity. It's a symptom of something much bigger. Silver is doing what it has always done in moments when people begin to question the stability of the monetary system. It's revealing tensions that most people still can't see clearly. Meanwhile, gold also had its best year in 4 decades, rising 65% to levels above $4,300 per ounce. But silver outperformed it by more than 2 to 1. This isn't a prediction. It's a logical consequence of decades of decisions that we're watching unfold now in real time. If you want to protect your wealth, if you want to understand what's really happening to your money, you need to comprehend why silver is behaving this way. Because history teaches us that when precious metals begin to accelerate like this, it's rarely an isolated event. History is an excellent teacher, and it shows us very clear patterns about how silver behaves during monetary transitions. Let's go back to 1979 and 1980. Inflation was eroding people's purchasing power. The dollar was losing international credibility. And what happened to silver? It went from $6 to $50 per ounce in less than 2 years. It wasn't because someone woke up one day and decided they liked silver more. It was because people began to question whether the paper money in their wallets would truly maintain its value. If you observe the period between 1933 and 1971, you'll see another fascinating pattern. For almost 40 years, the Bretton Woods system kept the dollar connected to gold. Silver was viewed primarily as an industrial metal, but when Nixon broke the dollar's convertibility to gold in 1971, something fundamental changed in people's perception of real money versus confidence-based money. In the years that followed, silver began to be seen again as a store of value. During the 2008 crisis, we saw the same pattern repeat on a smaller scale. When central banks began printing money massively to save the banking system, silver rose from $9 to $48. Between 2008 and 2011, every time the monetary system faces stress, silver reveals its true nature. It's not just an industrial metal, it's real money that has survived every monetary experiment in human history. That's why in these cycles, the rally isn't the risk is the moment when credit disappears. Now, in 2025 to 2026, we're seeing familiar signs: unsustainable fiscal deficits, debts that can only be paid with more money printing, geopolitical tensions that question the dollar's role as a global reserve, tariff policies that are reshaping world trade. Silver is simply doing what it has always done in these circumstances. To truly understand what's happening with silver, you need to understand some fundamental principles about how money works in confidence-based systems. When governments can create money from nothing, they will always create more than is prudent. It's a matter of basic political incentives. Politicians are rewarded for solving immediate problems, not for maintaining long-term monetary discipline. So when they face a crisis, whether a pandemic, a war, or a recession, the temptation to print money to finance solutions is irresistible. Governments create currency from nothing. Silver requires time, energy, and real resources. That's exactly why silver reacts first and reacts stronger when confidence in money begins to fail. When institutional investors begin to question the sustainability of monetary policies, they may not put 10% of a $1 billion portfolio into gold immediately, but they might experiment with 1% in silver. Since the silver market is much smaller than gold's, even small institutional capital flows create significant price movements. Small markets amplify big changes. What we saw in 2025 was exactly this. With gold already at elevated levels above $4,000, silver became the relief valve for capital seeking precious metals exposure with greater appreciation potential. But here's what most people don't understand about these movements. The majority of participants don't buy silver with their own money. They buy via futures contracts, leveraged ETFs, derivatives. When the price rises quickly, everything looks great. Everyone's making money. But when volatility explodes, as we saw with the movements from $86 to $72 in a matter of weeks, brokers demand more margin. Those without sufficient liquidity are forced to sell, even believing in the long-term thesis. The rally becomes a trap when the price rises and collateral shrinks. This is how small and volatile markets like silver can break even intelligent investors who are right about direction but wrong about timing and leverage. Being right doesn't protect you from being broke. During decades of stable economic growth, the financial system accumulates leverage. Banks lend more, consumers borrow more, governments spend more than they collect. This leverage works as long as the economy grows and assets rise in price. But when something breaks this cycle, a crisis, a war, a pandemic, the process reverses quickly. Suddenly, everyone wants to reduce leverage at the same time. When this happens, demand for assets that don't depend on other people's or institutions' credibility increases dramatically. Silver, like gold, is an asset that isn't anyone's liability. You own it directly. It doesn't depend on a government's or central bank's promise. Changes in perception about money don't happen linearly. They follow network effects. Initially, only a few people question the current monetary system's sustainability. They begin to diversify into real assets. But as more people observe these movements, as they see silver rising 148% in 1 year, more people begin to question their own assumptions about money. This creates a feedback loop that can accelerate very quickly. Here's something many people don't like to face. Mathematics doesn't negotiate with politicians. If a government has debts that grow faster than its economy, eventually there will come a moment when it can only pay those debts by creating more money. If creating money becomes the only way out of fiscal problems, then scarce assets like silver become more valuable relative to abundant money. Mathematics always wins. Let me tell a story that perfectly illustrates how these principles work in practice. Imagine two neighbors in the 1970 seconds, John and Michael, both workers, both savers, both trying to build financial security for their families. John observes rising inflation, sees the government spending much more than it collects to finance the Vietnam War and social programs. He decides to put 20% of his savings into silver when it was at $5 per ounce. Michael thinks John is being paranoid. The dollar is the world's strongest currency, he says. Why would you want to bet against the most prosperous country in history? Michael keeps his savings in bank certificates of deposit, earning 8% annually. It seems like a much more sensible decision. In 1980, silver hits $50 per ounce. John's silver savings had appreciated 10 times. Michael is still earning his 8% at the bank, but inflation during that period was 12% annually. He's losing real purchasing power, even with interest. What was the difference between them? John understood that when you have a confidence-based monetary system and when policies threaten that confidence, you need insurance that doesn't depend on the same confidence. Michael was thinking within the system. John was thinking about the system. Most people adjust the sails during the storm, Some check if the boat can withstand a bigger storm. Silver is the life vest you hope never to use. Let's apply these principles to what we see today. The American fiscal deficit exceeds $1.8 trillion annually. The national debt has surpassed $34 trillion. To pay just the interest on this debt, the government needs to spend more than $800 billion per year. Simultaneously, we're seeing geopolitical tensions that question the dollar's role as a global reserve currency. Countries like China, Russia, and even European allies are reducing their dollar reserves and buying gold at record levels. The trade tariffs implemented in 2025 created a new inflationary dynamic that hasn't existed in decades. The Federal Reserve, after years of ultra-expansionist monetary policies, now faces a dilemma between controlling inflation and avoiding a severe recession. Look carefully, and you'll notice we're at an inflection point similar to those that preceded major monetary changes in history. Silver is reacting exactly as we would expect it to react. It's not rising because people woke up one day and decided they liked shiny metals. It's rising because intelligent people are beginning to question the sustainability of the current monetary system. The fact that silver dramatically outperformed gold in 2025 to 148% versus 65% tells us something important about the speed at which these perceptions are changing. Now let's talk about what this means for you as an American worker who wants to protect the wealth that took decades to build. Most people think of inflation as rising prices, but that's just the superficial manifestation. True inflation is the expansion of the monetary base. Prices rise because there's more money competing for the same goods and services. If you have $100,000 in a savings account today and the government doubles the amount of money in the economy, your $100,000 buys half of what it bought before. Your money didn't disappear. Your purchasing power did. For decades, we were taught that diversification means a mix of stocks, bonds, and maybe some real estate. But all these asset classes depend on the same monetary system. If the monetary system faces fundamental problems, the correlation between all these assets increases rapidly. In 2008, we saw stocks falling, corporate bonds falling, real estate falling. Almost all dollar-denominated assets fell simultaneously. But silver, after an initial drop, rose 500% between 2008 and 2011. Why? Because it represents diversification from the monetary system, not just within the monetary system. One reason silver may be more relevant to the average American than gold is simply a matter of mathematics. With gold now above $4,300 per ounce, you need more than $4,000 to buy a single coin. For many families, this represents a significant percentage of their total savings. Silver, even with recent increases to $72.74 per ounce, still allows much greater granularity. You can build a position gradually. This makes it easier to implement a dollar cost averaging strategy in precious metals. But when should I buy? That's the question everyone asks. The answer is that you shouldn't try to time it perfectly. You should be building a position over time, like insurance. If you wait for confirmation that you're right, you've probably missed most of the move. Silver already rose 148% in 2025, but the fundamentals that drove that rise haven't disappeared. The goal isn't to maximize returns on silver. The goal is to protect a percentage of your wealth against systemic risks that could affect all other asset classes simultaneously. There's no one-size-fits-all answer. But if you look at recommendations from conservative wealth managers throughout history, you'll see that 5 to 10% of net worth in precious metals is considered prudent during periods of monetary uncertainty. During periods of greater systemic stress, some people increase this to 15-20%. The important point is that this should be a decision based on your specific situation, not on expectations of quick returns. If you decide to include silver in your wealth protection strategy, you need to think about storage, liquidity, and transaction costs. Physical silver has storage costs, Silver ETFs have management fees. Mining company stocks have additional business risk. Each option has trade-offs you need to understand before making a decision. The first thing you should understand is that buying silver as protection against monetary instability is fundamentally different from buying silver to speculate on short-term price movements. If you're buying as insurance, you hope never to need it. You hope the monetary system remains stable, that central banks maintain discipline, and that your silver simply keeps pace with inflation over time. But if the system faces real stress, you want to have this protection already implemented. Like any insurance, the opportunity cost of holding silver is the price you pay for the peace of mind of being protected against scenarios that are unlikely but possible. Given silver's volatility, which we now see on a dramatic scale with movements from $86 to $72 in a matter of weeks, trying to time the best moment to buy is generally a losing strategy. A more prudent approach is to define an allocation, target, say, 8% of your net worth, and build that position over 6 to 12 months. If you buy a little each month, you'll naturally buy more when prices are low and less when they're high. This removes the psychological pressure of trying to time it perfectly and reduces the risk of entering the market at the worst possible moment. Just as you diversify between different asset classes, consider diversifying between different forms of silver exposure. Physical silver offers maximum protection against systemic risks, but has storage costs and limited liquidity. Silver ETFs offer superior liquidity and zero storage costs, but depend on the stability of the financial system you're trying to protect against. Silver mining company stocks offer leverage to silver prices, but add specific business risk. A combination of all three can offer a balance between protection, liquidity, and appreciation potential. Buying physical silver now, with prices at $72.74, generally involves a premium over spot price that can vary from 15% to 30% depending on the form, coins, bars, and purchase size. Silver ETFs have annual management fees generally between 0.5% and 0.95% per year. Mining stocks have brokerage commissions and bid-ask spreads. You need to understand these costs and how they affect your net returns over time. Silver is one of the most volatile assets that exist. What we saw in 2025, movements from $29 to $86 and then back to $72, perfectly illustrates this volatility. If you're not psychologically prepared for this volatility, you'll probably make bad decisions at the most critical moments. Remember, you're not buying silver to get rich quickly. You're buying it as protection against systemic risks that could affect all the rest of your portfolio. Maintaining this perspective helps you stay calm during inevitable volatility. To use silver effectively as wealth protection, you need to pay attention to the same systemic indicators that influence its performance: growing fiscal deficits, monetary base expansion, geopolitical tensions, banking instability, changes in trade policies. All these factors tend to increase demand for assets that don't depend on financial system stability. Not because you're going to try to time the market, but because understanding the macro environment helps you maintain perspective during volatile periods. The current gold-silver ratio of approximately 59 to 1 tells us something important. Historically, this ratio has ranged between 15 to 1 and 80 to 1, with a long-term average around 40 to 1. At 59 to 1, there's still potential for silver to outperform gold, especially if industrial demand continues growing due to energy transition and digitalization. Even if you're buying silver as long-term protection, you should have clarity about what circumstances would make you consider reducing your position. Maybe it's when silver reaches a certain percentage of your total portfolio due to appreciation. Maybe it's when systemic indicators improve significantly and the risk of monetary instability decreases. Maybe it's when your liquidity needs change due to personal life changes. Having clear criteria established in advance helps you avoid emotional decisions during periods of high volatility. If you look at the history of the last 100 years, you'll see a clear pattern. Monetary systems based purely on confidence eventually face credibility crises. Not because people are irrational, but because political incentives make it very difficult to maintain long-term monetary discipline. Silver didn't rise 148% in 2025 because people like shiny metals. It rose because it represents something that cannot be created by political decree, cannot be devalued by central bank decisions, and doesn't depend on any government's promise. In a world where trillions of dollars can be created with a few computer clicks, real scarcity becomes increasingly valuable. Silver, besides being scarce, has growing industrial uses in renewable technologies, electronics, and medicine that gold doesn't possess at the same scale. This doesn't mean you should put all your wealth into silver. It doesn't mean you should try to become a precious metals trader. It means you should seriously consider having a small percentage of your wealth in assets that don't depend on the stability of the same system where you keep everything else. History teaches us that when monetary changes happen, they tend to be fast and dramatic. People who are prepared benefit. People who aren't suffer. The question isn't whether another monetary destabilization event will happen. The question is when and whether you'll be prepared. Silver isn't an investment. It's a wealth preservation tool that has maintained value through every monetary experiment in human history. If you truly understand the principles of how monetary systems work, if you understand the incentives, the cycles, and the mathematics of fiscal sustainability, then you understand that having a small insurance policy against systemic instability isn't paranoia, it's prudence. The 148% move in silver during 2025 wasn't the end of the story. It was just the beginning of a perception shift that could take years to complete fully. This is where the Fed enters the story, because the Fed doesn't control silver, it controls liquidity. When liquidity changes, margin changes with it. But let me be clear about how these types of movements end. They don't end in universal victory or defeat. They end in asset transfer. When the next phase of extreme volatility arrives, and it will arrive, those who entered leverage will sell in panic. Those who entered as insurance will watch in silence, perhaps even buying more. Money doesn't disappear during these episodes. It just changes hands, from the impatient to the patient, from the leverage to the conservative, from those who think in months to those who think in cycles. The choice is yours. But choices made during calm periods are always superior to choices made during crises. As history teaches us, the time to prepare for storms is when the sun is still shining. The storm is already on the horizon.